Hello and welcome to Financial Intelligence. In this video, I want to talk about the IPO market. When you listen to the financial media, there's a lot of talk about how hot the IPO market is and how people get rich overnight by participating in this market. However, this hype is created by the very same financial institutions which are going to benefit from the IPOs. It is essentially a trap for retail investors who are unfamiliar with how IPO offerings work. In this video, I want to show you that despite what Wall Street wants you to believe, the IPO market is not hot at all, at least for retail investors. In reality, the IPO market is only hot for investment bankers and their wealthy clients. In order to keep it hot, investment bankers continuously prop the IPO market to lure in more and more retail investors like us. Wall Street investment bankers promote the IPO market because somebody has to enrich them by purchasing the IPO shares at very high prices. If you like the type of content that I provide, subscribe to this channel and give this video a thumbs up, and also hit the notification bell so that you don't miss any of my future content. I have split this video into 3 segments. In the first segment, I'm going to give you a quick introduction to IPOs, and in this second segment, I'm going to talk about how IPO stocks are priced before going public. And in the third segment, I'm going to show you why the numbers reported by Wall Street to create this hype are fake and misleading. Part 1. Introduction to IPOs. An initial public offering, or IPO for short, refers to the process of offering shares of a private corporation to the public through stock exchanges. In essence, an IPO means that a company's ownership is transitioning from private ownership to public ownership. An IPO can be seen as an exit strategy for the company's founders and early investors, realizing the full profit from their private investment. Companies that are planning to go public hire investment banks to facilitate the process by marketing, gauging demand, and setting the IPO price and date. The sole goal of investment bankers is to create the largest amount of profit by creating hype around the IPO and selling the shares to retail investors at the highest price as they possibly can. Part 2. IPO offering prices. Investment banks make money on IPOs because they are allowed to purchase the company's shares at a discount. Then they can sell these shares to large institutions and brokers at a price level called the initial offering price. These institutions and brokers then turn around and resell those shares to their clients and to retail investors. These brokers and financial institutions will sell the shares at a higher price so they can also make a profit. As you can see, the shares change hands many times before being offered to the public in stock exchanges. Each party makes a profit from their engagement in the process. Therefore, by the time the shares reach the open market for trading, the stock price is usually significantly higher than its initial offering price. Part 3. Sample data from recent IPOs. In order to showcase my point, I pulled the data presented by NASDAQ's homepage on the performance of their most recent IPOs. This list might change as they initiate new IPOs, but the results of my analysis are unlikely to change in the future. I will share the link in the description box below so that you can check it out yourself. In this table, Starting from the left column, we have the IPO ticker symbol, the name of the company, the date of the IPO, and the fourth column from the left supposedly shows the first day return of the IPO. Interestingly, by looking at this column, you might mistakenly conclude that all IPO offerings had positive returns except for one which had a very small loss. This misleading data might encourage you to invest in future IPOs because it implies that you cannot possibly lose money. However, these numbers are fake because they are all calculated based on the performance of the stock during the first day of trading compared to the offer price. These numbers show how much money investment bankers and their clients make by selling the shares to the public. As a retail investor, you will never be able to buy these shares at the offer price. Therefore, these numbers are irrelevant for retail investors. To show you how much money you could have made during these IPO offerings, I have calculated the actual returns using the open price on the day of IPO and the closing price on the day of IPO. This is the realistic way of calculating the returns because the open price is the actual price at which shares are made available to the public. This table, starting from the left column, shows the ticker symbol, the name of the company, the offer price, the opening price on the day of the IPO, and the closing price on the day of the IPO. Column F shows how NASDAQ reports the IPO returns by comparing the close prices, in other words column E, to the offer prices, in other words column C. On the other hand, column G shows the actual returns, which are calculated by comparing the close prices, in other words column E, to the opening prices, in other words column D. As you can see, the actual returns are very small, and if you actually look at their distribution, they are not statistically different from zero. Therefore, by participating in these IPO offerings, the retail investors would make no money. The returns reported by NASDAQ, however, are way higher and show that investment bankers and their clients make huge sums of money on these IPOs. I hope that you liked this video. If you have any recommendation or suggestion, please add them in the comment section below. Don't forget to like this video and subscribe to this channel, and also hit the notification bell so that you don't miss any of my future videos. Thank you and take care.